Good afternoon, George Cavaligos at HFT Bonds. Well, I hope you guys saw the very early stuff I was posting last night in the chat room. I put some of it out on Twitter too, highlighting the danger of just this kind of reversal. You know, the Friday sell-off in the Treasuries fell on declining open interest. It was long liquidation. It wasn't like the Fridays that we've seen over the last couple months where we saw the Friday sell-off hit hard on increasing open interest. So that meant new shorts were coming in. And we got some follow-through on the downside this morning. A bunch of the gaps got filled. Bonds, ultras, 2 years, 5 years, everything got filled except the 10-year note. Sitting there waiting for the 10-year note gap to get filled. I should have been a little more preemptive and scaled into some longs down there. But retail sales numbers came out much weaker than expected, and the market just shot higher. I think we had one dip in the afternoon, back down to 11.5, and really we've been just chopping around up near the highs here in sort of a sideways consolidation. I think we're going to go at a minimum and retest Friday's highs here now. Well, we're heading into, the Humphrey Hawkins testimony Wednesday morning. The text will be released, I think, at 7:30 Chicago time. That's kind of a new thing. And then, we'll see the speeches all day, Thursday, and it's Wednesday and Thursday, actually. All day Wednesday will be the first one in front of, I think, the House on Wednesday and the Senate on Thursday, or vice versa. I'm not sure which one. And those will obviously be important. It's going to be one of those deals where you want to put in stop limits above and below, important areas to get yourself involved in case the chairman says something, earth-shattering like he did last week on that history speech that we got in the Q&A afterwards. So I think, what's he going to say? That we're going to do more QE? I don't think so, but, a lot of GDP estimates were being revised lower today. I think the initial estimates were up towards 2% for the second quarter. Now we're seeing like half of 1% to 1% kind of cluster. I find it hard to believe that the Fed's going to stop QE when growth is only a half of 1%. And employment's doing okay. It's not doing great. And a lot of it's part-time jobs too. This whole thing with, the Obamacare and everything kind of keeping a lid on people hiring full-time employees at this point. I guess it's easier to apply for food stamps than get a job, so everybody's doing that. All right, bonds and notes higher. Friday's highs, I think at a minimum, what was that, 125, 25 plus in the 10-year, and 135.01 in the bonds, and actually I think we'll probably go a little bit higher here. This corrective pattern's morphing into some kind of bigger complex pattern. If you remember in our pre-non-farm payroll webinar, I think I laid out a scenario very similar to this. The only thing I didn't count on was the market making new lows on non-farm payroll and then recovering those old lows and going into this corrective pattern that we've had, chopping around underneath us for the last 2 weeks. We got more of that ahead of us. So, keep a quick trigger finger, keep good stops. Like I said, short term, I'm looking for some higher prices. After that, we'll have to reassess again. I want to pull up some fib retracements. Now, obviously, the bonds hit at 135.01, the 61% fib retrace of the previous big sell-off from the week before. Now I'm going to look for the 79% fib retracement on the rally here, and I think we can get up towards that level here. I think it'd be a better corrective move after this massive drubbing that the market's taken here over the last couple weeks. I think that would be a much better corrective pattern. Actually, I would think we could get back to those pre-non-farm payroll levels again. I think in the, what am I looking at, the bonds here? So, back up towards, 135.30, 136, those levels over the next, week and a half, 2 weeks. The wave counts are pointing higher. It's tough in these corrective patterns because they continually morph into either more complex and more complex and more complex. And the market was due for a complex correction after the couple big waves of selling that we've seen over the last couple months. So we've got to keep a sort of short-term bias with our immediate bias on the upside right now, and then stay tuned to minute-by-minute analysis and keep an eye on open interest, look for confirmations. When the market does these reversals, Now we've got a bullish reversal today. Open interest should increase if we're going to see further upside gains. If it's a decreasing open interest on this rally, which is highly probable, then we're going to have to be real quick and make sure we have, you know, targets above, we hit them, we get out, or we move our stops up very tight to protect what little gains we can eke out of this corrective pattern here. So stay tuned to the chat room, stay tuned to the morning email. Have a great night, guys. We'll see you tomorrow morning.